Started.
Well, good evening, everyone. Welcome to the first of the year, first webinar of the year, to another On the Move. I would like to introduce my co-host, who's really the host who started it, Richard Checkan. He is the president and COO of Asset Strategies International, a coin dealer. We'll talk more about that later. I've known him for probably 30 years, and I knew his uncle who founded the firm for longer than that. So, Rich, over to you.
All right, thanks, Adrian. And as Adrian mentioned, we've known each other a long time. I got into this business and got to work closely with somebody I admired from the start, and I get to call Adrian a friend. So I'm very, very happy to do that. He's an amazing guy. He's appears everywhere, as you know. He started his own asset management firm. We're happy clients, and many of our listeners, I'm sure, are, and with good reason. He runs Peter Schiff's Euro Pacific Gold Fund, and he's written 3 books. He is the go-to guy when it comes to resources and international and global investing. So thanks, Adrian, for being here with us again, putting up with me. And we've got a fantastic guest, Brett Eversole. So Brett joined Stansberry, back in 2010, I want to
Yeah,
say?
2010.
I actually thought it was longer. Maybe it was in the background, I don't know, but I've known Brett for 14 years now, clearly. And he started working right away with Steve Sugarud, Dr. Steve Sugarud, who we've known for a very long time. Steve was the founder of Daily Wealth, True Wealth, and one other.
True Wealth Systems is our
True Wealth Systems, there we go. But what a lot of people didn't know is that Brett, with his mathematical and applied statistics background, was the guy who mapped all the models that they used in those systems. And we'll talk about this a little bit more later, but their success rate is unbelievable because of the amount of research they do and the approach they have to investing. So Brett's always been a good friend. I look forward to our get-togethers wherever it might be around the globe. And I'm really looking forward to hear your take on what's going on in this changing world. So without further ado, I want to welcome Brett Eversole to the program here tonight.
Yeah, well, thank you, Rich. I appreciate you inviting me. We saw each other in October at our Stansberry Alliance conference, and you extended this invitation, which I'm very excited to be here tonight to share some ideas. And Adrian, you and our paths haven't crossed as often, but I'm excited to chat with you tonight too. I know you're kind of a legend in this industry, so in the industry I work in the newsletter writing industry. So very excited, guys. Thank you for having me.
No, thank you very much, and it's a real pleasure to spend time with you. And when people say you're a legend, that's another euphemism for saying you're old. But I'll take it.
Knowing each other 30 years is another way of saying that too, by the
way. So let me kick it off. Rich already mentioned your background in mathematics and statistics. Your degree is in actuarial science. I thought people who became actuaries were people who found accounting too exciting. Sorry, but to be serious, that's an unusual background. I mean, statistics, we can all see where statistics and accounting has direct relevance, but actuarial science perhaps a little different. So how does this educational background of yours, how does it inform and how does it help your investment decisions and process?
Sure. Yeah. Like you said, my background is I got an undergraduate in actuarial science, and that's a kind of a fancy name that maybe people haven't heard, but that's effectively a statistics degree. So it's kind of just applied statistics. Really, you're taking those statistical concepts and applying them in, I would say, a relatively specific way to insurance pricing and risk adjusting and those sorts of things. So that I'd say with that background, I've always been good at kind of abstract problem solving. And what I've found as I've gone on through the years is you meet a lot of people who have more, let's say, straight ahead finance backgrounds, and they can be very, very good at the world of finance and investing. But I think they often end up a little too dogmatic to the world being, let's say, black and white. As far as, if you can build a discounted cash flow model and it tells you that this stock should be priced at $50, but it's priced at $40, well, the market's wrong and you can take advantage of that spread. Sometimes that works, but I think a lot of times there's something going on that you probably don't understand. And for people who have like a very pure finance background, I think it's a little bit difficult at times to break out of that, I would say, very dogmatic belief in this is how the world should work, and instead understand that the investing world is not very black and white very often. It's more all of these subtle shades of gray. And so I think with a background, I would say really in problem solving and critical thinking is really what a math degree really is. If you can do those sorts of things, then you can kind of attack problems in a different way. So that's really kind of where I come from. And then, Rich said working with Steve Sugarud. So Steve, again, I would say a legend in this industry. He's retired a couple of years ago. What was great about working with him is that he understood math and numbers in a very similar way that I do. But what he figured out very early on is that if you want to be a successful investor, those things are not nearly as important as understanding investor behavior. At the end of the day, a market is just made up of tens of thousands or hundreds of thousands or millions of sometimes irrational, but often irrational human beings. And because of that, the markets themselves often become very irrational, and they do things you wouldn't expect. And so getting a handle on, I would say, investor behavior and how that interacts with the raw numbers is really how you can get an edge as an investor. I don't know if you know this story or not, Rich. When Steve actually hired me, I'd been in the office working with someone else in our office at that time. And he knew I was a guitar player, and he was a guitar player as well. So he invited me one night to come jam with a friend of his. And we hadn't actually played together at all. But we sat around, and I don't know, I taught myself guitar from the ages of, 14 to 18, something like that. But I could improvise. And so they were playing some like jazzy chords, and I was just kind of playing over the top of them and having a good time. And what he saw out of that is what he thought was actually a really important skill set for investing. And that is, I was able to relatively quickly interpret kind of what was going on. And then I had a skill set that I could utilize to interact with what was going on in, maybe not the most exciting way that's ever been, not the best guitar playing that's ever been played, but I could go out there and play in that sandbox. And I think it is what a lot of an investor needs to do, is they need to kind of understand this big, complicated world that's going on, figure out how they can fit into it and how they can utilize the skills they have to take advantage of it. And that's where the human behavior and all those sorts of things come in. So I think having it again, back to the first idea, I would say a relatively non-dogmatic approach to how the world should be in the world of investing. And I kind of take what the market gives me and then focus on human behavior. And I think that's how I've kind of built a career, and that's how I have an edge as an investor. And I think anybody can do that if they take the time to think it through.
That's absolutely excellent summary. That was really good. And, this is one of my bugbears, to be honest. I think MBAs, as you say, they make people too narrow in their thinking, perhaps too linear in their thinking. And, we can both think probably of some, very good investors whose background was in psychology or whose background was in history. Now, I did a history degree. I'm not saying I'm a very good, but, history gives you not only do you understand what's happened in the past, but it also helps you see how sometimes what should happen isn't what happens. I would say even English literature, not one of these, woke gender neutral, whatever degrees, but a degree in English literature. You read how people act, how people interact. I think all of those things are very, very important for investors. And sometimes the MBA people, especially if they went from MBA and then they went to work for Merrill Lynch for 3 years, their thinking just gets too set, too rigid, and too narrow.
Yeah, I agree entirely. I think if you want to be a bond analyst, this kind of stuff is very, very good because the world of bonds is, very black and white. At the end of the day, there's not as much asymmetry that can happen in the bond market, but in the stock market and in the commodities markets and other things where there's not really price ceilings or price floors, you can't put yourself in that kind of box. It becomes very problematic, I would say. And you just end up it's just so easy to make bad decisions if you don't kind of understand how these things have played out over time. And I think your point about history is actually really important because, I've read dozens of investing books, and whether it's a book from the 1920s or the 1950s or the 1990s, the stories are kind of all the same. And I think
Yeah.
that's what's fun about investing to me is every market kind of feels like a market I've been in the past. It's just the tweaks and around the edges, it's different. And how do I apply what I've learned in the past to this new thing and what's different? And how do I take advantage of that? That's what keeps it fun and exciting for me.
Or maybe the 1630s even with the tulip.
So I want to touch on something you said there before I move on to the next question. But in your bio, you talk about your approach, right? Which is not everybody's normal approach, and you do have a system, if you will. And you can correct me if this is wrong, but it says you have a top-down investment approach. First goal is to spot the macro trend, the big thing with the tailwinds that you can't escape. And then from there, you look for opportunities based on valuation and overall market sentiment. And lastly, you look for momentum, and you don't want to invest in anything unless you've got momentum on your side.
Yeah.
So you want to elaborate on any of that? I mean,
Sure.
it's your
Yeah.
game
Yeah.
plan, and putting it out there. I don't think everybody can exercise that game plan. By the way, you have to have a skill set to do that. But
Sure. Well, yeah, when I started working with Steve, his mantra that he'd always kind of pounded home was cheap, hated in an uptrend. And those are kind of the ideas.
I can hear
You want
Steve
to,
saying that.
yeah, exactly. You want to buy things that are undervalued. The numbers do kind of matter. Like you can make money on an expensive stock getting more expensive, but unless you really have an edge there, you're kind of playing a potentially dangerous game. If you can buy things that are inexpensive, that's going to give you a big margin of safety where your risk is going to be a lot lower. And what's nice about that is usually the things that are inexpensive, the market is not that interested in. So what I like to do is find corners of the market where people just don't really care about. I mean, as you know, Rich, like gold, it kind of fits that bill perfectly right now. The price of gold has been going up, but no one really seems to care about it. And that is a huge benefit as an investor, because if you can find something that no one's else interested in, well, as the price goes up and up and up, people are going to get interested in it. And so when you can find something that's cheap and hated, but the price is just starting to move in your favor, what that means is you've kind of done this fundamental analysis to say, okay, most investors don't like it, and I know I'm getting a good price. The problem is if price is going down, it can keep going down and down and down and down and down for way longer than you might be willing to hang on. So if you wait for the market price to reverse, that's kind of like the overall market and all the people involved in that giving you a thumbs up and saying, okay, you're safe to act.
No, it's time.
So as I've come along, I've kind of become I would say a relatively strict momentum type investor. I think that following the trend is the easiest, safest way to make money in the markets. And then the fundamentals can be very important to figure out, if you've got 5 things that are all going up strongly, which one maybe has the most upside potential or where do you want to put more of your bets. But yeah, that cheap hated uptrend mentality is something that Steve drove home for me. And it's definitely become the mantra that I live by too.
For sure. I can see the contrarian in you over the years. I can't tell you how many times, I've kind of looked back and I see you making a recommendation. And nobody else is making that recommendation. Like, what the heck is he doing? Everybody is convinced the stock market's going to fall, and you come out with the melt up,
Yeah.
narrative. So I've seen that play out over and over with great success. So we're going to tap into you here tonight. We're going to say, okay, we've got a lot of change going on. I don't know if we have a lot of momentum right now, but we got a lot of change for sure. With President Trump, number 47, this time taking over, and he's going to make some changes. He's already made changes in the first couple of days. What's the biggest impact you see on the markets going forward? Let's start with the equities markets.
Sure. Well, I mean, I would approach that question in 2 ways. So, and maybe they sound like they contradict, but I don't think so. You'll tell me if you think they do. I would say that presidents can have a profound impact in certain areas, but broadly, the market doesn't really care who the president is. The stock market tends to not care whether it's a Democrat, whether it's a Republican, whether it's Trump, whether it's Biden. Markets can kind of do what markets do, almost regardless of who the president is on a big, broad macro scale. Now, what I will say is that there's something very interesting going on in that we are starting a new presidency, and that starts the clock on a new election cycle. And so this is a thing that people have ran the numbers on and talked about for decades now. But while who is president might not matter quite as much on the whole, where we are in their presidency tends to actually be very, very important for market returns. So if you run those numbers back to 1928, so this is the start of year one, would have been January 1st this year. You run those numbers back to 1928, and the way it turns out
Not a good
is,
year for Hoover, by the way.
yeah,
Or the
turns out
next year is horrible.
the first year of the cycle is okay. I think the market goes up around 5 to 5.5%. The second year tends to be very bad, where it's about around flat, maybe plus 1%. The third year is very good, like 15, 16% gain. And then the fourth year is around a 5 or 6% gain. So pretty good. I think the general thought behind this is that presidents come in, they have an agenda that's probably not necessarily geared towards the economy. They spend their first 2 years working on all that thing and they kind of put the economy to the side. Then they wake up in year three and they're like, oh crap, I've got to get reelected. So then they start doing all the economic policy that helps boost markets as they go out and head towards that next, presidential election. Now, here's something that's interesting. I just ran these numbers the other day, and if you look back throughout history, the first year is not really a year to write home about. But over the last 10 cycles, so back to 1984, the first year has become the best performing year of the election cycle indicator. So over the last 10 cycles, the first year has been like a 17.5% gain in the S&P 500. I think the logic or the thought behind this is that we've moved towards just a state of, I would say, constant gridlock. And so now a new president comes in, they've got lots of ideas, but maybe they can't implement them quite as easily. Or if they have ideas that are easy to implement, they're probably more economically focused. And so therefore that year one has actually turned out to be a very, very good year for the markets overall. So I think broadly, we're in a position where with that cycle indicator behind us, almost regardless of what Trump does, we have a potential for this to be a very, very good year. And I know that even that idea has become, I would say, relatively contrarian. We just finished a second calendar year of 20% plus gains. The market is expensive based on about any measure you would look at. But to me, we're in a position where I think the stocks can just continue ripping higher. There's just so many catalysts. The economy's in a very good place. I think Trump's going to do a lot of economic policy. Sorry, go ahead.
I said, here you go again.
And I just think we're in that kind of position. The only time in the past where we've had back-to-back 20% years followed by another 20% year was in the middle of the 1990s. And there's only a couple of other times where it's happened. The market was generally up a small amount in year three after those. I don't think we had any big downturns. But in the 1990s, we had 5 straight years of 20% plus returns. So it's very, very easy to assume that things can't get better because they've been very good. At the end of the day, the trend is really, really important. It's really, really strong right now. And I think with a new president coming in, he's probably going to shake things up. He's going to focus on the economy. I think we're in a position for the market to do incredibly well here in 2025.
Before you carry on, may I just, there's so much there that I'd like to comment on, but just one thought on cycles, cycles and correlations and so on. I'm glad you sort of explained why you sometimes get the effect, because often people will come up with some kind of correlation or cycle, but if there's no fundamental, if there's no rationale for it, it's just a sort of, it could just be a statistical anomaly. I remember Mark Farber once saying very, very facetiously, but he said the best predictor of the S&P is the monsoon season in Bangladesh. It has a 100-year track record, but can't be beaten. But my point was this: it was interesting you said how it's shifted over the last 10 years. We've certainly seen that. Do sometimes these cycles just become sort of self-defeating when too many people know it and too many people try to act on it?
Yeah, I mean, that's obviously anytime you have kind of an anomaly in the market that people learn about, they tend to go away. And so that's what I think is actually interesting about what's happened over the past 10 cycles, over the past 40 years, is that we have seen a pretty serious shift in year one. And what's interesting about that data, though, is year one has gone from the third best year to the first best year. The other three are in the exact same spot. So year two is still pretty darn bad. Year three is still almost as good as year one. I think it's around a 16 versus a 17% return. And then year four is okay at maybe 5 or 6%, something like that. So it's really just this year one shift that's happened over the last 10 cycles. But your point is definitely well founded in that sometimes these things, you can always data mine your way into something, whether it's useful or not. I think with something like this, we have at this point a good bit of data. And if you had told me 20 years ago that this shift was happening into year one, maybe I wouldn't quite believe it with just 4 or 5 cycles under the belt. I think once you get to 10 observations, then okay, there's something going on here. And none of this stuff is a guarantee, but to me, investing is always about building kind of a body of work. It's not, I'm going to rely on this one thing to tell me that this or that is going to happen. But this is just kind of like another arrow in the quiver of reasons to be bullish. And I think I don't know, people have just had this disposition for the last couple of years as we came out of that 2022 bottom to find reasons to poo-poo this bull market. And that's been pretty counterproductive.
Missed out on a lot. They've missed out on a lot.
Yeah, it's been pretty counterproductive for the last 2 years. And I mean, this kind of gets into I would say another personal philosophy that I'm just an optimist by nature. I just can't get away from that. The Warren Buffett quote of, never betting against America, I think is always something that's kind of stuck with me. And, we were talking, Rich, before we got on the call here about, there's lots of reasons to say that we do this wrong or we do that wrong. But at the end of the day, the United States is still the United States, and the US stock market is still the envy of the world. And so I'd rather go out of my way to try to find reasons to be positive than be negative. That doesn't mean I'm blind to the negatives when they're out there, but yeah, I definitely have a positive bent.
Well, another thing, if I may, on this broad philosophy, before I know we want to get into the markets,
yeah,
pretty soon. That's probably everyone at home
is. If anybody has questions, they can start firing them away.
Yeah, everyone at home is getting their coffee when we're talking, or scotch when we're talking about this, but. I'm sorry. There's a couple of thoughts that occurred to me. You mentioned mean reversion earlier, and then you talked about momentum. So no question, the momentum is on the side of the U.S. stock market at the moment, and there's a lot of reasons for that. Not least of which is the excess liquidity that's been created over the last 14 years. It has to go somewhere. That's why we've got Bitcoin and gold and real estate and the stock market all going up at the same time.
And bananas stuck to walls too.
Yeah, but I wanted to raise a couple of things, if I may. On mean reversion, you look at the U.S. stock market, which, depending on what indices you use, whether you just use the free trading index, the free stock index, or all index, and so on. But the US is now over 70% of global market capitalization. If you look back, over 30 or 40 or 50 years, when the US has been very strong and very dominant, you might say that's beginning to get a little bit excessive, and don't the other countries matter at all. So I'm wondering about mean reversion on markets, US versus global. And then the other thing is a more broader thing, if I may get your opinion on this, on, a philosophical approach to investing. I mean, everybody likes predictions, but we all know that we're not in the business of making predictions unless we're trying to sell newsletters. An investor is in the business, in my view, of assessing risk and reward. So you might say, I think the momentum's very strong. I think the odds are it will continue to go up, but the risk is increasing at the same time. And so maybe as an investor, I need to take some of my profits, reduce some of my exposure. And of course, if you take some profits because the market's going up, you still have a high exposure.
Yeah. Yeah. I mean, I think it's important to remember that when it comes to, when I write a monthly newsletter issue with a recommendation, I'm not really doing portfolio management. And when an investor is reading my work and then fitting what I wrote about into their portfolio, they're really doing portfolio management. And when it comes to portfolio management, there's a lot of ways to reduce risk. We always recommend trailing stops on our recommendations, but kind of the easiest way to reduce your risk in a position is to own less of it. If you are, 70% stocks and 30% bond, or, whatever your mix might be, if you're worried about the stock market, you can just own a little bit less of it. That's always a very simple way. And I think as an at-home investor who's taking care of this, it's so easy. I've met so many readers throughout the years who they say to me, I love this idea and that idea, and I bought a little of this and I bought a little of that. And then I woke up one day and I looked in my portfolio and I owned 400 positions and I still had 25% cash, and I don't know what to do with this. And what they didn't do, they took kind of the newsletter approach to building a portfolio and not the portfolio approach to building a portfolio. And so those are two very, very different skill sets. So I think there's a lot of ways to approach risk management in a portfolio context, and simply owning a little bit less of some things here and there is a good way to do that. And then also there's obviously, hedging and those sorts of things as well. And that comes to your point you were talking about before, the US being 70% of global market cap. While I'm very bullish on US, I think that we are in the early stages of a kind of a secular dollar bear market. The dollar bottomed in 2009 and then kind of double bottomed in 2011. And it's gone basically nowhere but up until it peaked in late 2022. And that's done a kind of an interesting thing in my view. And I'm kind of the poster child for this. I started in this business in 2010, basically at that dollar bottom. For the last 15 years, if you owned anything but US stocks, specifically large cap US stocks, it was a drag on your portfolio. What that means is we've trained an entire generation of investors to assume that owning anything but large US stocks is a dumb idea. Now, if you study any kind of history outside of the last 15 years, you know that that's absolutely not the case. And I think if we have a turn in the US dollar, it's going to create a massive headwind for US stocks, which I think they can still do okay through, but a massive tailwind for foreign markets. And so if you're worried about the US maybe being a little too much in global market cap, well, own some Europe, own some Japan, own some China, own some emerging markets. Like you can diversify your way out of that problem and put yourself in a position where if the US zigs, these other markets can zag, and you can actually have, I would say, proper portfolio risk management. So there's a lot of ways to do that. I kind of answered your two questions, but if you have follow-ups, please.
Oh, no, that's good.
I do have a follow-up. So you touched on something at the end, and I'm running into more and more people that are in one of two camps. And we're eventually going to get to the questions we wanted to talk about. But I'm sure this is helpful. I know it's helpful for me, so I assume it's helpful for others. The two camps that I'm running into are either diversify, right? Manage the risk, make sure that you don't have the big loss, versus buy the best and go all in. So now you're only holding a handful of stocks, but they're the best of the best. The products people can't do without, et cetera. And basically, the folks that are in the latter say that the people in the former only do that just so they don't lose customers, they don't go broke, right? They don't lose all these positions from unhappy clients. If you're really good at your job, you can get them to make a lot of money with just a handful of stocks. What are your thoughts on that?
Well, it's funny, like we keep like abstracting away. So we started with a single investment idea. How do you find a good investment idea? And then how do you fit those into a portfolio? And that's a very different thing. And now what you're describing in my mind kind of sounds like, how do you build a portfolio within the context of a financial plan? So where are you in your life? Where do you want to be? How long do you have to get there? What do you need when you get there? And so those kind of questions, that determines how much risk do you want to take, or are you willing to take, or those sorts of things. So
how much time do you have to recover?
Exactly.
Yeah,
exactly. So if you're 40 years old, then, and you have, 50% of what you need when you're 60, then you're going to be able to take a lot less risk than if you're 50 years old and you've got 25% of what you need when you're going to be 60. So it kind of like we're abstracting it out. And I think that financial plan aspect is, where do you want to be and what kind of returns do you need to get there? And then how do you build a portfolio around that? At the end of the day, there is no one size fits all. As you get kind of more towards that financial planning type thing, there's definitely not one size fits all. And that's, I would say that's relatively not outside of my area of expertise, but it's not what I think about on a day-to-day basis. But I think when it comes to risk generally, the amount of risk you should take is probably a little bit less than you think you can, because you probably can't handle as much risk as you assume that you can. Think about how you felt in March 2020 or in October 2022, and look at what your portfolio was then. And if you felt terrible, like most people did, then you should probably, reduce your risk to a certain extent. Think about that, because good portfolio construction only matters if you can weather the worst. Because if not, you're going to make bad choices at the worst times, and you're going to absolutely blow yourself up, and you'll pay
Right.
for that for years.
Good point. Good point.
Right.
So,
Want to move on?
yeah, I think so. I think you're next, Adrian. What do you got?
Okay. Well, I wasn't going to mention Mr. Trump, but since you've already mentioned him, I'm allowed to. So, one of the things he did on day one of the things was declare a national energy emergency. So let's talk. I know you've written about energy. You have thoughts on energy. This is a very open-ended question. How do you view the energy markets now? How do you view them playing out over the next sort of year, 2, 3?
Sure. Yeah, I think the oil and natural gas markets are very interesting right now. We're in a spot where Trump's coming in and he's going to do deregulation. He's going to make building pipelines easier. He's going to cut down a lot of red tape. And it's kind of funny to me that is the approach. I don't necessarily disagree with it, but we're producing 13 million barrels of oil a day in the US, the highest on record by far. We're very close to all-time highs in natural gas production. He says drill, baby, drill, but we've been drilling, baby, drill. We've been drilling like crazy. And so energy is interesting because if we do a lot more production, that's going to suppress prices. And so you're in this spot where prices are not super high. Natural gas prices have had a pretty good spike recently, but oil prices are not very high, and we're drilling a lot of it. If we're going to up production dramatically, that's going to suppress prices down. And so I think that those maybe the big integrateds and the producers might actually be in a tough spot in this environment. However, I think that there's very obvious winners in the pipeline area and in the midstream companies.
And the service.
Yeah, and services companies. Because if we're going to have a lot more drilling, what we're basically going to have is an activity boom, not necessarily an oil price boom or an energy boom in the historic sense, but I think an activity boom is possible. One of the companies I really like is Enterprise Product Partners. They've got around 75,000 miles of pipelines in the US. ONEOK is a midstream company that I like a lot as well, where they do a lot of extraction services, and then they have pipelines. They do trucking, transportation, all these sorts of things, where if there's more rigs going and more extraction happening, they're going to have a lot more business running through their what are essentially toll roads. What's interesting about these companies right now is that you can still buy them at very good prices because they, for better or worse, even though I would say their core business doesn't really trade with the price of oil, but their stocks tend to trade with the price of oil. So you can still buy them at good prices today, even though their businesses are doing fantastically and have been, because we have this massive production that's already happening. So I think broadly, yeah, I think it's going to be a good time for the activity side of the energy market. But if you look at the Chevrons and the Exxons and the big producers, they might not have great stock charts in a year or two, while some of these other players have performed incredibly well. That's kind of where I see it. I think there'll be some bifurcation in that market.
The two stocks you mentioned, do you mind giving us the symbols?
Enterprise Products Partners is EPD, and ONEOK is OKE.
And are you buying those? Would you be buying those now?
Yeah, those are both active recommendations in one of our portfolios.
Okay.
Yeah. I like those. I like those two a lot. ONEOK especially isn't interesting because it has the pipeline business, but it also the pipeline business is essentially a toll road, right? So they build the infrastructure, they pay people to push product through it. Those are generally done on contracts where they're relatively fixed, so that even if production goes down, they still get paid to a certain extent. But that's a relatively low margin business. ONEOK is more of a midstream type company where it has that business, but it also does much higher margin service businesses, and then kind of last mile transportation, if you will, on trucks and ships and those sorts of things. So it's a little bit riskier, I would say. It's going to trade a little bit more with the price of oil than the pure pipelines, but that's a company, I think it's compounded at 12 or 15% a year for the last 25 years. It's just been fantastic.
Wow. Do you follow any of the drillers?
I would say that I don't very specifically. There's, depending on how you go in that market, you can go from I would say relatively non-volatile to very, very volatile. And the drillers are just a little bit too out there for me. Those things can trade absolutely wildly, a little too high a risk profile for what I'm after.
Okay.
You take out your trailing stop in the first 10 minutes.
Yeah.
Um, what are your thoughts on alternatives? Uranium is uranium's day coming? Are we going back that direction, or is there too many skeletons in the closet?
It's tough to say. It's not something that I track incredibly closely. I feel like I've been hearing people say that uranium prices are going to, 5x for about the last 15 years, and they've finally been right-ish for the last year or two. I think one thing that's interesting is there have been big announcements from some of the hyperscalers, Google and I believe Microsoft, that they're working on buying out some old nuclear reactors and setting them up
Mothballed
for the
reactors. I read the same.
yeah, and putting them together for, we've been hearing about, or I feel like I've been hearing about a need for a nuclear energy renaissance in the US. And while people have talked about it a lot for the last 2 or 3 or 4 years, there hasn't really been a lot of action on it. I think if Microsoft puts its own reactor into place to meet its, AI data center power needs, that's going to be a very clear and obvious use case. And they have the $5 or $10 billion to throw into CapEx that they don't need. So they're I think those kind of companies could kickstart that renaissance we've been talking or hearing about needing for a long time. I think nuclear energy makes a lot of sense for the next 30 or 40 or 50 years. But obviously there's a lot of hurdles. Maybe we get red tape cutting from Trump, the administration, that allows those things to get put up much more quickly. But yeah, it's not something I track super, super closely. It's always just felt like a bit of a pipe dream, but maybe we're getting close to it. I think it would be great for, the US as a whole, and probably for the world as a whole, if that really does come to fruition.
Do you have any views on oil versus gas? I mean, does one look better to you than the other? Oil companies rather than gas companies?
I think in that case, so like a company like One Oak is probably 60-40 gas. Yeah, I think in the activity business, probably gas is probably looks a little bit better. I think that you're going to see a lot more volatility in pricing on the gas side, and so you're not going to see. So if oil goes to $100, you're going to see a massive amount of pickup in production. You don't really get that kind of uptick in the gas market because the price is always so volatile. So I think you probably have a little more steady state in the gas market, almost no matter what the price is doing. Whereas in oil, it's more of a global market. So it's going to be a little less. What's the right word? I don't know. It's going to be able to move around a little more without affecting it as much.
Right,
So,
right.
yeah.
Forgiving. All right.
Rich?
Yeah. So we're going to skew a little bit away from, energy and general equities market questions. Our audience tends to skew precious metals and commodities in general, precious metals specifically. And I know you have some specific thoughts on our hated, barbarous relic gold and other sister metals. What are your thoughts, going forward on the precious metals market? What do you see for 2025? Let's just start there.
Yeah, I mean, I very broadly, I would say I'm very bullish on gold. Silver, I don't track as much, and then platinum, palladium, I like as well a lot. Obviously, the gold market I think has stumped a lot of people. You know exactly what's going on, Rich, and I'm sure you do as well, Adrian. Where there has just been no retail buying at all, but the rally has been completely created by central banks, and that's this is. This to me is the personification of that cheap, hated in an uptrend idea. The cheap maybe not so much anymore at $2,600 an ounce, but you can't really put a valuation on gold the same way you can on a stock. But sentiment-wise, there's just zero retail enthusiasm for gold. One of the things I like to look at are the big ETFs, the exchange traded funds. You can look up their share counts. And these share counts fluctuate based on essentially investor demand. So if a ton of folks come in and try to buy GLD, which is the largest gold ETF, well, that fund is going to create shares to sell to them, and then it's going to buy the gold to, stockpile, to back those shares. And so what that means is based on if there's a lot of people buying, they're going to create more shares. If there's a lot of people selling, they're going to liquidate those shares. So the share count fluctuates. Now, if you look at like an S&P 500 fund, that's not really going to tell you much. It's always just going to kind of go up and to the right. But for more specific funds, something like gold, you'll see a lot of fluctuation up and down over time. So right now, GLD shares outstanding, the total share count is down by about a third versus where it was, I think, about 3 years ago. Um, IAU is the second largest gold. Between the two, they're probably 95% of the gold ETF market. That's also down by about a third versus where it was a few years ago. So these ETFs are definitely the retail end of the market. And these folks just, they have no interest. They're not only are they not buying, but they've been selling en masse. So these folks are absolutely flooding out of the gold market. That's at a time when the smart money, the central banks are buying, and you have an incredibly strong uptrend.
You didn't just call central bank smart, did you?
But and then you have this incredibly strong uptrend at your back. So this is like the perfect, in my mind, the perfect cheap hated uptrend type trade is what's happening with gold right now. I saw it somewhat sidelined, but I think gold stocks are an absolutely incredible value right here as well. They were having, go ahead.
They really haven't gotten into this yet. So.
Yeah, I mean, they were having a pretty good year until the last 3 or 4 weeks of 2024, and then they gave up almost their entire gains for the year. I think they were up around 40% at one point in late November, and ended the year up around 10%. So a lot of those gains have been given back, and those companies saw absolutely massive cost increases with the global inflation that hit, but those have pretty much settled down now. Their all-in sustaining costs have pretty much flatlined / come in line with overall, lower 2, 3, 4% inflation over the last 18 months or so. And these companies are just minting money at $2,600 an ounce gold. And so I think gold is going to go a lot higher. I think the gold stocks are positioned really, really well for that. And Rich, I know you like silver. That's not something I track quite as much.
Yeah, gold is always number one. It's insurance. I don't buy it to make money. I buy it to protect the rest of the portfolio, right? Mm-hmm. So you put a little bit, 10% into that, and you hope it does nothing while 90% of your portfolio goes to the moon. That's what I love about gold. Silver, I see it has its moments. Maybe a little bit for the insurance for divisibility. If everything went to hell in a handbasket and you got to barter for a loaf of bread, which I never think is going to happen. I think we're well beyond that. We've evolved, right, as a society. So I'm not one of those gold dealers that believe that will happen. So really for me, silver comes down to profit potential. And that's usually late stage bull markets, right? Where it catches up with and surpasses gold. That's where you see the big payoff in silver, but it's strictly for me a profit play. And take a position. If it doubles, I sell half, that type of thing. No emotion at all. But you also like platinum and palladium, two very much industrial metals, obviously attached at the hip. They're not what do you call it? Siamese twins, but they're pretty close. Yeah. What are your thoughts there? Because I know you see some possibilities.
Yeah. I think the macro story is just that the world got way ahead of itself in projecting where we're going to go with electric vehicles. It's kind of the simple story. So platinum had a great run in the late 2010s. Palladium had a ridiculous run in the end of the 2010s. And then electric vehicles were just taking over the world, and they were going to crush, internal combustion engine demand. And we were at this sea change moment. And that's really important because, especially for palladium, I think around 70% of their demand is catalytic converters. And 95% of palladium demand is industrial use. I think it's around 90 for platinum, and maybe only around 40% of platinum use. It has some other uses as well, is catalytic converters. But internal combustion vehicles are very, very important for the platinum and palladium markets. But I think we just got way ahead of ourselves. We've seen not slowing EV sales in the US, but slowing market share. So they were taking up market share at an astounding rate in 2020 through 2023. That actually slowed down where they lost market share in 2024 in the US for the first time in a long time. And so I think we're seeing a slowdown in that adoption, especially here in the US. And what's happened is platinum has gotten incredibly cheap. Palladium has gotten incredibly cheap. Palladium's fell about 70% from where it was at the end of 2022. And that was kind of like a crazy run that it happened in that moment. But it's just gotten way too cheap. Platinum trades at its largest discount to gold that it ever has right now, or at least it did in the last few weeks. The only time we saw something close was near the bottom in 2020. And over the next year, platinum doubled in price, while gold was up, I think, around 30 or 40%. So platinum is just too darn cheap compared to gold, as far as I'm concerned. And palladium is incredibly hated by investors after it's had this 70% decline. I like to look for commodities at the Commitment of Traders report, which is a weekly report that comes from the CFTC. And it tells you what futures traders are doing, what bets they're making on various commodities. So according to that, and these people, of course, are you want to make contrarian bets based on what they're doing. If they're all selling, you want to buy. If they're all buying, you want to sell. And the Commitment of Traders for palladium has just been crashing for the last few years. And it finally bottomed and had a major reversal at the end of 2024. And to me, when sentiment is getting more and more and more and more and more hated, that can go on for a long time, especially when prices continue to fall. When you see that reversal in sentiment off of an extreme bottom, that's something you want to look for. And we saw prices in palladium have a pretty solid rebound since then as well. So they've given some of those gains back, but they had a very nice pop off of that kind of sentiment bottom and reversal. And so to me, these are very different trades than what I see in gold. Gold is kind of like the layup, but your upside is not, it's going to be muted compared to if these two go right. I mean, I think platinum and palladium, if this trade works out like I expect, and there's no guarantee that happens, I think they could probably, platinum could easily go up 50 to 75% in the next year or two, and palladium could easily go up 100 to 150% in the next year or two, based on the price action we've seen over the last 5 to 7 years.
And would you buy those two physically through ETFs, or would you buy the mining companies?
So there aren't really a lot of mining companies. I like the ETFs. Anglo American Platinum is the easiest way to make that, or I think probably the best way to make that trade. If you want to do the mining companies, it's a South African company. Most of their operations are in South Africa. The risk profile of this might not be right for everyone. But they've been operating for a long time. Obviously, Anglo American as their parent company is, they've got probably a century plus of history. This is, it's a relatively small company with relatively niche assets, but I don't think it's super risky considering where the operations are and things like that. I mean, I think you'll probably get more juice there, but obviously the risk is.
You froze up a little bit at the end when you're talking about the risk, but you're on.
Oh yeah.
So you're saying there's a lot
just
more risk, but
yeah, the risk in the mining stocks is going to be higher. So I mean, I think that you'll get a little more upside potential, a little more juice in that trade to go with something like Anglo American Platinum. But yeah, the risk profile is definitely higher. So be aware if you're using the 25% trailing stop, that might not get you very far in a stock like that.
So, Rich, I have to say, he didn't freeze up at all for me here in Puerto Rico. So if you want good internet connection, reliable power,
so we're at 83 degrees right now, right?
Yeah.
Just so our listeners know, so Adrian, we know, is in San Juan, Puerto Rico. He was bragging how it was 83 degrees today and sunny. In Florida, Brett was telling us it's in the 20s. This is Florida now, mind you.
North Florida.
Is it still the Sunshine State? And then
not today.
And then here in Maryland, when I revved up my car this morning, it was 3 degrees. So yeah, we're a little jealous, Adrian. No,
yeah. Yeah.
I'm a real Floridian, though. I went to the office this morning in flip-flops in 28-degree weather. So for what it's worth.
Oh, well, there you go. So, Rich, do we have questions coming in?
No, and that's what I was just going to say. So normally we are inundated with questions, and I don't know if anybody is aware that they can send us questions. We definitely have a bunch of participants. I want to know what's on your mind. So start typing them in there if you have questions for Brett. It's a lot easier to ask here during the webinar than after the fact, trying to get them done with emails or whatnot. So by all means, ask us. Anything else on your mind at this point, Adrian, you want to cover?
Yeah, let me step back a bit, if I may. You're obviously someone, Brett, who thinks about markets and thinks about, investing very broadly and very deeply. There's obviously no one way to climb the mountain. There's a lot of different ways of doing it. But what are some of the biggest mistakes that you've seen investors make? I mean, do they over diversify, not diversify enough? Um, what are some of the biggest mistakes you see people make?
Yeah, I think the biggest mistake that I've heard from my readers over the years is something that I kind of touched on earlier, and that is thinking about um, every trade or every investment that they make on its as it's though it's on its own little island, and not about how it fits into their entire investment portfolio. It's just very easy. I in a talk I gave a few months ago, I talked about this idea that diversification is really, really valuable, and it doesn't count as diversification if you own 25 gold stocks. You just you're just a gold stock investor at that point, and so it's very easy to I think everyone has things that they like and things that they don't like. And when it comes to the investment world, it's very easy to end up buying a lot of the things that you like over and over and over again, and then thinking that you have that diversification aspect set up, but you really don't because you've just bought the same stock 5 or 10 times. So that's a mistake I've definitely heard people thinking about. I would say not being intentional with what they're buying, how it fits into what they already own,
Yep.
and kind of what do they need that they don't have in their portfolio, and is this filling that need, or is it just a recycling what they've already done? I think being very intentional about that portfolio construction is really important. It's such an easy thing to kind of screw up as an individual investor.
Yeah. Yeah, no, absolutely. I'll echo both of those. I think one mistake people make is just picking up ideas from different people. It might be newsletters, it might be videos that people do, it might be the dentist or the Uber driver. But picking up ideas that maybe sound very good at the time, but in 3 years' time you've forgotten who recommended it to you, you've forgotten why you bought it, and it's just another idea that was good at the time, and you've no idea why you own it. And the other thing I'll say, yeah, I agree completely what you say about diversification. And now I'm not a huge fan of over diversification. Warren Buffett famously said that for a lot of investors, diversification is an excuse for ignorance. To me, it's much more important to spend time really knowing and understanding a company, and if you're doing your own work, and following that company and having high conviction about it. If you really know and understand a company, you will have a much better idea what to do if the stock price goes up a lot or if the stock price goes down a lot. Whereas if it's just a sort of idea that sounds good at the time, my experience is that often when the stock price goes down, people just panic and get out because they don't know it well enough.
Yeah.
And so I agree with you completely. And I think there's when you said about people just keep on buying, let's say, more and more gold stocks thinking they have diversification, I think people have too many individual names within one sector, which means that you're not always buying your highest conviction stocks. If you're investing in a sector like gold stocks, whether you have, depending on the size of the portfolio and how much you follow it and everything else. But if you have 2, 3, 4, 5 stocks, presumably these are companies you know well. Mm-hmm. I see people who bring me their portfolios to look at. Literally, sometimes people will have 200 or 300 stocks. And I'll ask simple questions like, oh, I don't know that one. Is that in production or is it exploration? Yeah, I'm not quite sure. They're meant to go into production. Well, is it gold or silver? Yeah, one of the two. Well, that's not very helpful.
Yeah, I agree entirely. And I think it is okay as well if you have, and this is what I do a lot, especially in one product we have is kind of like a broad trend following type product. You don't have to necessarily do the deep fundamental research to find the one gold stock. It's okay to just buy GDX, which is the broad idea. If you have a broad thematic idea, you can choose to roll up your sleeves and try to find the best company, but you're also adding some asymmetric risk by doing that. If you might get the big idea wrong or the big idea right and the stock wrong. And so if you don't want to take that kind of risk, it's okay to buy the ETF that tracks the entire sector. You can still do incredibly well doing that sort of thing. And in the product we build, what we do is instead of trying to find the best stock in, say, the biotech sector because we like biotech, we just buy biotech, but we buy it with the leveraged ETF. And that is going to juice our returns if we think we have the momentum correct. But we don't have, asymmetric risk if the company we bought comes out and they failed their phase 3 trials and it goes down 70% on, the day after. So depending on what you're trying to do, it's okay to make a more broad bet on a thematic idea and then find another way to juice it if you'd like to do that, whether you do that with options or leveraged funds or whatnot.
Sure. And of course, it depends on how much time and effort and
Sure.
knowledge you want to bring to any particular sector. This is now maybe 10 years ago, but I started my firm in 1991. So, 10 years ago, I already had 20 years plus of experience. And I did an analysis of where the returns came from. And, broadly speaking, was interesting. I would say about 30 or even 40% of the returns were simply from getting the macro trend right.
Mm.
Gold stocks are going up, you're in gold stocks, that's 30 to 40%. I would say another 30% was the individual stocks you picked. So if you have the time and effort and expertise, very, very important. And the rest of it, maybe 20%, was simply what I call the mechanics. Buying an exploration stock at 40 cents and not at 50 cents. And selling some of it when it went to $1, and just some mechanics, if you like. But again, also very important. So I think all three of them are very important.
All right. Well, we are starting to get some questions now.
Yeah, I think that feels about right intuitively. That's not an analysis I've necessarily done in a hyper specific way, but I think intuitively that feels about right. That I think getting the big picture story is that's kind of step one. I'm a top down, not a bottoms up kind of guy. So yeah, for me, getting that big picture right is I think the most important. I think it's also the easiest thing to do if you have an approach that allows you, the cheap hated uptrend thing like I spoke about. Like I think it's very simple, but I think it can give you an edge to find the big broad themes that a lot of people have missed. And so to me, that's the easy way to get to third base. And then you do all the rest of the homework to try to get to home.
Well, to me is I'll say one of the saddest things in the investment world. One of the saddest things is if you get the macro right, you get the trend right, and you just pick the wrong stock. So gold, the XAU is up 30% and you're down 10%. And in gold stocks, as well as biotech and some other sectors, which are very asymmetrical stocks, that can easily happen. It can easily happen that you pick 5 stocks and lose money when the index is up. It's also very sad when maybe you get the stock right, but you didn't buy it right and you didn't sell it right. And a lot of people who have day jobs or better things to do with their time, like play with the grandkids or grow roses, you miss things. So that can happen as well.
Yeah, I've definitely fallen victim to that. I'm thinking back. I wrote an issue in January of 2023, and it was just big and broadly bullish. I at the time I thought that really the problems that plagued the market in 2022 were high inflation, and it seemed pretty clear to me in early 23 that the inflation problem was mostly solved. I think the market hadn't woken up to that yet, and so I thought stocks were going to absolutely soar that year, which is exactly what happened. And I wanted to play it in a broad way. And generally speaking, off of those kind of bottoms, you get massive rallies in biotech stocks. So instead of, buying the Qs or buying a broad NASDAQ type fund, I made a biotech recommendation that we ended up losing money on while the market, went up 30% that year or something. So, I've made it up later and got into those other things, but I've definitely fallen victim to that where it's easy to get, I would say, get the big picture right and then get a little too cute on trying to make the actual investment recommendation, figure out the absolute best thing, when if you have the big picture right, maybe not play it safe necessarily, but don't overthink yourself out of making money.
But don't make it too complicated. Yeah,
exactly.
Yeah.
All right. Well, we've got some questions brewing. And Todd was the first in, so we'll go to Todd. He said, do any of the panelists see a credit crisis? on the horizon?
It's not something that I have concern about now. Like these sorts of things, I think it's always a concern, but to me, you just look at what the market's telling you. The bond market is the smart money. We've seen, you could say it's complacent how tight credit spreads are right now, but we've just seen no uptick whatsoever in high yield spreads or in investment grade credit spreads. And so to me, maybe there's something out there that could happen, but I've got to see at least those things start to spike a little bit to have the market tell me that maybe there's something underway.
Any thoughts on that, Adrian, or is that
covered? No, that's good.
All right. Sarantos, Sandy says, Brett, where do you see Dow Jones and S&P 500 going this year? And are we still at the market melt up you had mentioned last year, or are we still, I guess, melting up as you mentioned?
Yeah. We talked about this a little bit early on in the webinar. I think we're primed for another very good year in the U.S. stock market. In my mind, we didn't talk about this at all. But a couple of years ago, I started writing about an idea I call the Dow 150,000. And that's the idea that we are not, this was at the end of 2022, near a bear market low. And the idea is simply that I believe that we're not at the late stages, but in the middle of a very long-term, what I would call a secular bull market. This secular bull market began in 2013 when we broke out to new highs for the first time. And these tend to last about 16 to 18 years. So right now we're about 12 years into that. So based on where we are in that cycle, I think that this very big long-term bull market has a lot of room to run. And obviously we have this massive catalyst coming through the AI revolution that's going on right now. I think a lot of people are keen to poo-poo what's going on and assume that it'll not materialize into anything. But to me, it's kind of, whether that turns out to be correct or not, I think it's almost certain to spark a boom and probably a bubble very similar to what we saw in the 1990s in the dot-com boom. And this is just based on a pretty simple idea of, technical or technological innovation. What tends to happen in these sorts of things is you have a brand new innovation that comes out. People spend ridiculous amounts of money building out infrastructure to make this thing possible. We saw this with fiber optic cable being laid and commercial internet in the 90s. We saw it with the railroads in the 1800s. People build way too much of this infrastructure. It gets very cheap to use because it's overbuilt. And then people build new economies and new businesses on top of it. So if you think about that kind of like technological cycle, where we are right now, all we're doing is building data centers. We're just building infrastructure. We're not anywhere near the true phase where you would get a bubble, which is when people start building businesses that maybe are or are not of as much value as people put on them. That's going to be a couple of years down the road. So I think big picture, the bull market that we're in can run for many years. And I would say, as far as like where we are in the AI cycle, I think we're probably like, third or fourth inning, not eighth or ninth inning, like a lot of people seem to think. To put it on like the 1990s analogy, I think it's a lot closer to 1995 than it is 1999 right now. So I think there's a lot of room to run this year and in years to come, right through the end of this decade.
Well, you mentioned AI, but do you see any rotation in the market? There's been obviously value stocks, defensive stocks, small cap stocks, income stocks, not to mention commodity stocks have all lagged. Do you see rotation?
Yeah, I think not on a sector basis, but on a size basis, there's a lot of value in small and mid caps right now. I think the S&P 600 trades for about an 18 PE versus probably a 26 or 27 on the large cap index, and the mid caps are somewhere right in the middle there. I think what's probably going to happen with AI is that it's not going to turn into massive amount of like commercial products that you and I use on an everyday basis. I think it's going to end up probably at the enterprise level doing a lot of efficiency, like massively improving efficiency at the enterprise level for corporate America. And what that really means is margin expansion. And so I think that's going to be the trickle down that's going to happen. And when it starts to hit those smaller and mid-sized companies and they start to get these margin expansion, I think that's how you're going to get multiple expansion, and then a lot of price increases. So I think you can't kind of go away from, the Magnificent Seven and the large cap stocks right now. But I think if you want to, maybe like we talk about de-risking, like you could de-risk some of those positions by owning some smaller and some mid-cap stocks right now. I think is a smart bet.
Yeah, yeah. Well, I would say it's unlikely that Nvidia will grow as much next year as it did
Yeah.
last year. The stock, that is. Or it will probably be, I don't know, I was trying to look at it as we did, but it would be something like 6 times the size of the S&P right now. So that's unlikely that the growth will continue at the same rate.
Yeah. Yeah. It's interesting though. So I found these charts and I put them in a presentation I did a few months ago. In the 1990s, so Cisco was kind of the poster child of that boom. Cisco 100x'd its revenue from 1991 to 2000, which is pretty incredible to think about. Like it's kind of unbelievable, honestly. But if you look at a chart of their earnings per share growth versus their share price growth, they basically tracked each other from 1991 until about 1998. You didn't have the share price absolutely take off above the fundamentals until the last point of that boom. And it got wildly and ridiculously overvalued by the time it peaked in 2000. But that was really only the last 2 years of the 1990s, even though it had already probably, 40x its revenue by that point. Nvidia is in a similar spot right now where its earnings per share have gone up about as much as its share price over the last 3 or 4 years. So we haven't seen that kind of like blow off bubble type behavior.
Right.
I think it's hard to say with a $3+ trillion company that like you say, it might have to turn into a $10 trillion company for that to happen. I don't know. We live in a different world as far as market cap sizes and things like that. It's hard to get your head wrapped around, but the point is the stock price completely disconnects from the fundamentals. That hasn't happened yet. And to me, that is another sign, talk about body of the evidence. It's another sign that we're not at the very end at the late cycle, but we're more the mid cycle of this whole thing that's going on with AI.
All right. Next question from an anonymous attendee says, is it true, and I'm not sure that I understand this, is it true that gold has not fully offset the debasement of the US dollar? Do you know what we're getting at there? I'm not really sure.
I know people like to take like a dollar in 1900 and then do the inverse inflation rate and then say it's down 98% since then,
Yep.
Which I think is a chart crime of sorts. So maybe that's what they're talking about.
Yeah, I'm not really sure.
Gold has certainly outperformed inflation since it became fully traded, and probably even back to the 1930s, I would guess.
Well, it had an official price, for many years. So until 70, can't track
Yeah.
it.
Yeah. But I think it's outpaced inflation since it was freely traded.
Yeah. No, but I think the question is saying that the dollar has lost more purchasing power than gold has gone up over 100 years. Now, since it's been freed, that's obviously not true. In the last that's 50 years now, isn't it?
Yeah,
wow.
It is just over 50 years. And, I get into this argument a lot with people where they say, if you track gold back 100 years, it's not fair. I mean, you can't make that analysis because, if only freely traded from 71 on, anything going back beyond 71 just doesn't make any sense. Yet people do it all the time. They're like, well, from 1913 to 1971 didn't do anything. Like, yeah. It did one thing, we revalued it in 1933. That's why they collected gold to devalue the dollar. But other than that, not much happened. But once you get to freely traded, then I think you can make some sense out of what's going on. All right. I don't know if we answered that or not. If there's more to it, send it again. I'll consider that done at this point. Warren says S&P 500 has been going up for some time, and I'm in a good ETF. What do you see as the risks for this year and or drawbacks? I think we covered some of this as well. Also, if I wanted to hedge, would an option be appropriate, and at what percentage compared to the main investment? I'm not sure which of you is best to answer that question. We probably both have a thought. It's not me, I know that.
I can answer the first part. I'm not sure about the hedging part necessarily. I think the risk. So what tends to happen in bull markets, which is what we're in, is that as long as earnings are growing, markets go up, and multiples tend to expand. So you think about, you get to the price based on the earnings times what people are willing to pay for them, right? So if the earnings are $10, people are willing to pay 10 times earnings, then your stock price is going to be $100. So if in the next year the earnings go to $12, people are probably going to be willing to pay more than 10 times for that because now the earnings have gone up by 20%. So generally in bull markets, as long as earnings are growing, the market's going to keep going up and people are going to be willing to pay more for those earnings. We saw this throughout the 1990s. We had those 5 straight years of 20+% returns. And basically at the end of 1995, the market was the most expensive it had ever been outside of 1929. And then it went up 25% a year in 1996. And then it was the most expensive it had been. And then it went up, and then just that cycle continued. And so to me, the risk, the thing you have to worry about is if earnings, instead of going up, contract, because that's what really puts fear in people's minds. And they say, okay, I wasn't worried about paying a lot for stocks because I knew the fundamentals were continuing to improve. But people won't want to pay a lot for stocks if the fundamentals are deteriorating. And so then you get a double whammy where instead of the earnings going up and the multiple going up, now you have the earnings going down and the multiple going down. That's how you get a major sell-off and potentially a bear market. So I think the fundamentals of earnings are the most important thing. And if that breaks down, that's the real risk.
Right, right. Well, I'll make a couple of points if I may. One is, if I may get a plug in for gold stocks, bit off a tangent, but that's one of the reasons I like the gold stocks. Because the earnings are going up and the multiples are not expanding. In fact, the multiples are contracting even as the price of gold and as the earnings are going up. And as you say, normally that's the opposite. On the question of hedging, let me just make a couple of points. I mean, to me right now, buying puts on the S&P are incredibly cheap. So you can get really good insurance very cheaply. Now, let me just say that buying puts generally, or buying options as opposed to selling options is something I don't like. The vast majority of options will expire, which means the seller made money and the buyer lost money. So buying options typically is not something to do, and it's typically either a speculation, if you're buying calls normally, or it's a hedge. Now, right now, I just looked this up. The S&P is at just over 6,100, and it was just it was just over, let's see, you only have to go back to the middle of the year to see it, 5,200 or whatever. So you can buy a 1 year put on the S&P right now, pay about 2% for a 5,200. To me, that's not overly expensive hedge. If you see it as a hedge, if you see it as insurance on which you will probably lose everything.
Mm-hmm.
But of course, if the market comes down to, 58, 57, 56, those puts are going to move dramatically. And again, I'll just pull it up. I mean, again, back in August, you were 300 on this particular put, and now you're at 86. So, I mean, the leverage, last week, my gosh, it's almost lost 50% of its money this month. So, as a hedge, I don't think, or as insurance, I don't think that's awfully expensive insurance. When I buy insurance, I don't like to go too far out of the money, because of course, the more out of the money you are, buying calls above the market or selling puts, buying puts below the market, so you're in the money, but the more away from the current price you are, the more quickly the value is going to evaporate, obviously. So I don't like to go too far away. But anyway, for someone who knows what they're doing, I don't think that's expensive insurance, but it's insurance. It's probably going to lose money.
Okay. I've got a clarification a little bit from the question on gold. So restated, is it true that gold's performance has not offset the loss in purchasing power of the US dollar since 72, or since, basically since they started freely trading. Um, any thoughts there? I mean, from my standpoint, I'd have to do the math. I'm not going to be able to do it here in this format. But my gut feeling is I really don't care what the dollar does. What I care about for gold is it maintaining its purchasing power? And, to me, it has. Whatever I could have bought, back in 1972, I'm pretty darn sure I can buy now with an ounce of gold. I can't do it with the same dollar. So
Yeah.
I don't know if that answers the question, but
Yeah, no, it's not true. You can look at the last 4 years, gold has gone up more than the loss in purchasing power of a dollar. You can go back to 2000, this century, the same's true. I mean, obviously,
Yeah.
going back to 1971 is a little bit artificial because it was a coil spring in
exactly, it was ready
1971.
to pop.
Yeah, but no, it's not true. I think gold has maintained its purchasing power and more, over any reasonable period you want to pick, 5 years, 10 years, 20 years, 50 years. I mean, you can obviously pick a starting date and an ending date where that's not true. But no, generally speaking, it has well maintained its purchasing power.
Yeah, I see 6% a year since 1971, 72, whenever it free floated, which is far more than the inflation rate over that time. And if you put it at 1980, which is about the worst starting point you could have, I get 3.5% a year, which is probably pretty in line with average inflation over that period. Maybe even too high, given that cuts out the 70s.
Yeah, so it's taking care of business. The other thing I'll throw out here is obviously everybody looks to gold in inflationary times. I forget the fact that during deflationary times, gold is probably at its best. And you don't have to go too far back to see that. 2022, I mean, a year where everything was absolutely god awful miserable. Gold far outperformed everything just by being flat and holding its value. So in deflationary times, gold does incredibly well. Don't forget that.
Right. It's interesting when you ask the question. I'm a historian by my education, and I went to history. Brett immediately started giving us the numbers.
See, we got it all covered here tonight. So thank you for that. I appreciate it. So since you are a numbers guy, the next question from another anonymous attendee, or the same, I'm not sure. Brett, being a numbers guy, what do you think of the extreme cyclical nature of Bitcoin? With hindsight, looking back, it follows very predictive cycles, both up and down.
Yeah, I would say it's a mistake I've made, but I've thought this for years and haven't changed it. So maybe it's not a mistake. Maybe it's just who I am. I don't find Bitcoin to be interesting. I don't know why necessarily. I've been around through the duration of it coming into existence and being a nothing and then turning into a big thing and then disappearing and then turning into a bigger thing and then disappearing again and all of these sorts of things. And I think looking back, the cycles do become obvious. I think when I first saw, I would say it really got like majorly on my radar during the 2017 boom. And I think for every boom that's happened since then, I felt like it's gone so mainstream that it can't keep living in these cycles. And I've been proved wrong about that, in that the adoption just keeps getting larger and larger and more institutional and bigger and wider audience and all of these sorts of things. And so I've missed this so many times that you should not take my advice on Bitcoin, I would say. I don't understand it. Yeah, when I said not interesting, that's not the right way to phrase it.
Yeah.
It's just I've never been able to get my head around it or understand why it works the way it does. And I think one of those rules as an investor is you just don't buy things that you don't understand.
Absolutely.
And so, yeah, it's just not something. I agree. The cycles are obviously there, but I can't tell you if it's going to stay in those cycles. I would have told you it was going to be done with those cycles in 2017 because it had hit such a mainstream kind of known choice, but that was just completely obviously dead wrong. So you don't want my advice there.
Just looking at it from a common sense standpoint, I think it'd be a lot easier to figure out where it's going if we knew what it was going to be used for and how it was going to be, completely adopted into society. I don't think we know that yet. I think the purists, the original purists, are unhappy that it's not meeting Satoshi's, vision right now.
They don't
I
like BlackRock selling
Yeah,
Bitcoin
it's a
ETFs.
15-year-old, angst-filled teenager that doesn't know what it wants to be when it grows up.
Mhm.
You know, the what I do like about it is, and people are going to jump on me for this when I call it a hard asset, but it is a hard asset in the idea, not that you can bounce it off a table, but that, the bottom line is over time, there's less and less available, right?
No, I disagree with that. Okay, go on, finish what you're saying.
And you may be right. I don't know that we know yet. But the thought is it's going to be a hard asset. And that's what we like about gold. It's the same thing that drives people to gold, I think, or draws people to gold, I think, draws people to Bitcoin. It's the idea that, you know, centralized fiat has been screwed up for millennium. And we're tired of it. So people are looking at an alternative to that. And I think that's what's giving it life. What its life will be, I don't know that we know yet. And I don't think you can predict that until some more time passes.
Uh,
Adrian.
Sorry, on Bitcoin, obviously, there's the formula and they do fewer and fewer Bitcoins each year and so on. But there's no shortage of cryptos and there is no potential shortage of cryptos. People can create cryptos out of absolutely thin air, as we saw last week with both the Trump coin and a Melania coin. Why don't we have the son? What's his name? Baron. Why don't we have a Baron coin?
Or an Adrian
You
coin.
can create a new crypto out of nothing. And so there is no shortage of cryptos, is the way I look at it.
I do agree with that, Adrian, to a certain extent. I think that was a pretty compelling argument maybe 6 or 8 years ago. It does seem as though Bitcoin has a brand name and a staying power that has, to a certain extent at least, made that argument, I would say, less compelling. If that argument was correct, I don't think there's any way we would have $100,000 Bitcoin, which we've had recently. And so I understand where you're coming from, but I do think that there's like a critical mass that Bitcoin itself has hit. And I think people do interact with Bitcoin differently than they do any other random coins that come up, or the ones that say they
Yeah,
have
I agree with
uses or those
that.
sorts of things.
I agree with that.
So
I think you could turn out to be correct, but at least right now, I don't know if that's how people interact with it. And
I
that's all that
think
really
that as
matters.
well. So we were at a conference in Miami, and Porter was there, right? And one of the points Porter made, and it kind of one of those light bulb moments went off. It's like early on, you got the guy who paid like 28 Bitcoins or whatever for a pizza pie, right? Boy, he wishes he had that back right now, but it's gotten to the point where, like gold, when you have Bitcoin, you are not looking to spend it.
Mm.
You're looking to hold on to it, right? And if you spend it for any reason, you think you screwed up. That's kind of the way people look at gold. So I do think the mentality is changing a little bit, but again, it's still way early on. But there is that thought that I have Bitcoin and I don't want to let go of it,
Mm.
right? Because of what they've seen happen so far. I think it's still greed driven at this point, but
Well, in 1633, people didn't want to sell their tulip bulbs.
I was just going to say tulips. I knew it was coming.
You knew I was going to say that.
Yep. And you may be 100% right. And I just don't know that we know at this point. So I'm along for the ride. We'll see where it goes. Dan, let me see. Assuming I want to buy platinum and palladium or something else, would you recommend a minimum size and percentage? I don't know if we can, but we'll give it our best shot. For instance, 0.1% will not make any difference to your overall return, even though the price goes up 100%, and you are probably losing your time with this, not enough conviction play. Okay. So thanks for clarifying.
Yeah. So this is kind of like back to what we were talking about earlier, like kind of like a portfolio construction question.
Yep.
I think when it comes to position sizing, I think, yeah, you have the exact right thought. You want it to be large enough that if you're right, that it matters, but not so large that if you're wrong, it's going to kill you. So generally, if you want to have a somewhat, but not ridiculously concentrated portfolio, you probably want to own around 20 to 25 positions, which puts you in the 4 to 5% per position type range. And so then if you have a 4% or 5% position, say, if that doubles, that's going to be a meaningful difference in your portfolio. But if you lose 25%, you're going to lose 1 percentage point of your overall portfolio, something to that effect. So I think, yeah, you're really asking like a position size question. I think probably the 4 to 5% range is about right for most people, so that they're not taking too much concentration risk. However, if you have a slightly higher conviction or slightly lower conviction idea, you can move those numbers around a little bit. But that's generally the range that I would recommend is 4 to 5% of overall portfolio.
Yeah, and I agree with that 100%. And I think your sort of principle enough to make a difference, but not enough. But if it goes down, it affects your ability to eat. Is even more true when you come to speculations. I mean, if you're buying Nestle and Microsoft, you could say, well, yeah, you can have a larger position. But if you're buying a speculation, I see people who will put ridiculously small amounts of money into things that they're hoping will go up 10 for 1. But if they go up 5 to 1, which is still not bad, it's made absolutely no difference to the portfolio. So there's no point in taking the time and energy, to do it.
All right. I've got two more questions and a comment, and I'd like to get through them. I don't think we're gonna have time for any more because right about here is where I would be cutting off questions so we can end on time at 8:30. I hope it's okay, Brett, if we just run a hair over to get these in. First one, I don't know if this is tongue in cheek or if it's real, but I laughed a little when I read it. So Todd was asking, has Brett looked at the top-down view of coal?
Coal. Yeah, we actually have done a little bit of work on coal. Coal's kind of an interesting industry because it is very much dying and on the way out.
Except in China.
Well, that's true. Yeah, U.S. coal at least. One of the interesting things, and this is kind of one of those sentiment phenomenons you find, is that there was a coal ETF in the past, and it was so underowned that they decided to shut it down. That was mid 2020. And then the underlying basket then proceeded to go up by about 1,000% over the next 18 months, I believe. So one of those things, if you see a massive amount of ETFs on a certain sector or something shutting down, that's probably a pretty good contrarian indicator. But coal is just like an industry that's slowly dying and on its way out here in the US. Natural gas is taking over that role. I mean,
I don't know if I'm losing everybody or not, but this is my internet probably.
Yeah, you're still there. I'm still here.
Okay. All right. I'm sorry. I popped out and came back, and I thought I was going to lose everybody in the process. I apologize for that.
saved them.
Yeah, I need to move to Old San Juan, I guess.
But just a comment. Even though coal is clearly, it's clearly a declining industry. Let's not forget that there's still an awful lot of coal used in an awful lot of countries. And even though we keep saying China uses all the coal and blah blah blah, China is going, quote, green at a fairly dramatic pace. The growth in EV cars, for example, from China is much faster than the growth in North America. It's just that, they're starting from such a low base. But you look at India, you look at Indonesia, those countries are still using coal. And on a comparative basis, if oil and gas get too expensive, they will increase their coal consumption. And that's going to be true for a meaningful amount of time, I think.
Okay. All right. And then the last one, so I don't have it in front of me because I lost it when I lost the screen, but I want to say the question had something along the lines of what's the impact of the forward-looking impact on the stock market at $700+ billion deficits on a monthly basis or whatever it is. So basically, with the deficit spending that we're on the pace to do right now and to continue to do, what's the impact on the forward-looking markets?
Yeah, I think to me, this is a short-term versus long-term question. In the short term, deficits are fantastic for the U.S. economy and for U.S. stocks because they drive economic growth, um, and that leads to stronger earnings, and that leads to higher stock prices. Of course, you have to pay for that over the long term, though, and the question is how high can the deficit and the debt go before it actually hits a critical mass, a tipping point where it matters. Um, it seems like people have been worried about that for 30 years, 40 years, maybe longer than that, and it hasn't mattered yet. I'm not naive to think enough to think that it won't matter ever, but it's just, I would say it's beyond my ability to predict when we're going to wake up and it's going to matter. I think it's going to happen one of these days, but I don't know if that's going to be tomorrow or if that's going to be in 2075. And so as an investor, it's just not something that I don't spend a ton of time worrying about or thinking about over the long term. But yeah, in the short term, deficits are great for the economy because it drives growth, and growth is what drives stock prices.
It drives liquidity.
Yeah.
Yeah.
All right. Well, thank you. We covered a lot of ground. We didn't have any questions there, and then all of a sudden we had more than we can handle. So thank you all for sending them in and participating tonight at the webinar. Before we break away, I want to go ahead and make the rounds. We'll start with you, Brett, go to Adrian and myself. If you could, just kind of the last parting shot, what do you want to leave on people's minds from this webinar? And then how can they get a hold of you?
Sure. Yeah. I mean, as an investor, it's figure out what works for you, figure out what your process is going to be, figure out how you can have an edge, and then stick with those things. And then, I think the positive, the optimistic outlook is always the right disposition to have. I think that's done good things for me in my career and throughout my life. And so I hope people kind of have that tilt as well to their, everything they do in life and towards their investing as well. To find more from me, you can go to dailywealth.com. That's the free e-letter that we have, and I write that 2 or 3 times a week. So you can hear more from me there. And yeah, I appreciate it, Rich.
Yeah, glad to have you. Adrian, your thoughts?
Yeah. As I mentioned, there's more than one way to climb the mountain. So I think what's important is that you have an approach that makes sense. I don't mean be stubborn, but stick with an approach. And as Brett said, do what you understand. And if there's something you don't understand or you don't know well enough, you don't have to be invested in every market all the time. You don't have to have a position or a view. You can sit things out. That's okay. So if anyone has any questions for me that were not answered, please do send them in either to Rich or to me, Adrian Day. What is it? Asset management at adrianday.com. Maybe sending them to Rich is going to be easier. But I'm happy to answer any questions that were for me. I didn't really talk so much this time, I don't think, or I didn't give my opinions much this time because I was really, really interested and fascinated to hear from Brett. Brett's someone I've known about, obviously, but we've never met, I don't think. Maybe at a seminar we said hello. So I was really very, very pleased and interested in all of the things you had to say. And frankly, I just wanted to learn. I didn't want to keep interrupting. So if you want more information on what I do, we manage money for retail people, both in global markets as well as in resources. We don't really have set minimums. It's whatever makes sense for an investor. And you can go to adrianday.com to learn more.
Sounds great. And by the way, all the ways to reach us will be in the recap that goes out tomorrow to everybody. So you'll get a link. So if you can go back and see where I lost connection and came back and all that, you can replay it for the ages. So you'll get all this tomorrow as well in a follow-up email. Thank you for coming. From my standpoint, I think Brett touched on a point. It's one we know, but you don't invest in things that you don't understand. It doesn't mean you can't invest in them. But maybe you don't take the lead there, right? So knowing people, having a bunch of people in your stable that can help you with areas that you aren't an expert in. That's what I do. That's why, I've been a good friend of Adrian for years. I glom on because I know his expertise. It's one of the reasons I followed Brett for so many years. I know what he brings to the table, and I value that. So, having good people with you is how you can get by, because nobody can be an expert in everything. It's just not possible, I don't think. What I know is I know gold, I know silver, no platinum, palladium, and I still believe, and you're hearing me say it again, but I think gold and silver are just screaming buys. As you say, gold's kind of a layup, and I 100% agree with that, even at all-time highs. It'll go out in the recap tomorrow, but anybody that makes a purchase by tomorrow night. So we're going to put an ending on this. From tomorrow morning when you get the email to tomorrow night, if you make a purchase with us, just at our minimum. So one gold coin, one platinum coin, one palladium ounce, 100 ounces of silver. If you meet the minimum, free shipping, handling, insurance, done. Okay. Now that's going to be for our U.S. clientele. I can't send one bar all over the world and make that work. But certainly for our U.S. clientele. Sorry about the discrimination. I want to thank everybody for coming with us. Put it on your calendar. We know who we're going to see next time. And who is it, Adrian? For our
Well,
webinar?
it's Peter Schiff.
Yeah.
And we may have a few different opinions from Peter than we got from Brett.
Okay. So I'm really looking forward to that. We've known Peter a long time. Obviously, you've worked with him for a long time. So
Yeah.
I'm looking forward to that conversation. That's going to be on Wednesday, March 12th at 7 p.m. Eastern. So looking forward to that. Thank you all for attending. Thank you. Big thanks, Brett. And as always, Adrian. And look forward to the next time. Thanks.
Thank you.
Thanks, guys.
Good to meet you, Brett.
Yeah, you as well. Thank you.